With financial innovation, more and more financial products are being innovated to satisfy diversified requirements of investors. Due to the rapid evolution of financial system, strengthening financial supervision has become more and more important. Financial supervision is a universal task. Many countries, including some advanced economies, have been penalized for weak financial supervisions. For China, this task is particularly relevant, as the authorities are well aware that Chinese financial system is faced with risks associated with economic transition, in addition to credit and market risks common to all countries. In fact, before 1978, under the centralized plan economy, there was no financial regulation in the true sense. After the foundation of the People's Republic of China in 1949, the Communist Party gradually steered the nation towards a centrally planned economy modeled on Soviet Union. Under the so-called socialist transformation policy, private businesses were turned into collective ownership and eventually state ownership. Thereafter, as the economy was centrally planned and composed overwhelmingly of state-owned enterprises, there was little need for the existence of financial markets to fund businesses and allocate resources. Hence, the financial markets established before the socialist transformation policy were dismantled during this time. First, all stock exchanges ceased to operate in 1952, putting an end to securities market. Secondly, the People's Insurance Company of China, namely PICC, was shut down in 1959, quickly followed by the closure of the insurance market altogether. Finally, in the banking sector, the People's Bank of China became the only bank operating in China, acting both as a central bank and a commercial bank. Although the People's Bank of China provided the traditional service of savings and lendings, it functioned essentially as an instrument of the government rather than a real commercial bank. The People's Bank of China was used primarily as a conduit through which the state money was channeled to fund state-owned enterprises and the order from the government. In short, there was no financial regulation in the true sense of the term. In 1978, the economic reform policy was introduced, making an important watershed in the development of China's financial system and indeed the general economy. The banking system was reformed to keep up the transition to a market-oriented economy. At the starting point, the Big Four state-owned banks were established and reopened to provide specialized services. The more and more commercial banks were allowed to set up at the national and local levels. The other parts of the financial system also underwent significant reforms and developed rapidly. The securities market was brought back to life in the early 1980s. Likewise, insurance market was revived with the reopening of the PICC in 1980 and the formation of more insurance companies thereafter. As a consequence of the reform, the Bank of China, the People's Bank of China, took on a dual role in financial regulation. It performed the major functions of the central bank, while at the same time supervising and regulating the whole financial system, including banking, securities, and insurance. This effectively rendered the People's Bank of China the single financial regulator at that time. Then, with the rapid development of the financial markets since the early 1990s, China has been moving steadily towards a sectors-based regulatory model with separate regulators for banking, securities, and insurance.